reinsurance is really just insurance for insurers, and there are really two aspects to it. So the first is the ceding of risk, which is basically the transfer of risk from the insurer to the reinsurer. And then the second aspect is that in order to gain this cover, the insurer to gain this cover for this risk from the reinsurer, they pay the reinsurer a premium. Okay, so why would an insurance company have reinsurance? So the main idea here really is to try and smooth the claims experience. And what that means is to try and increase stability of the claims and decrease volatility. So what I mean by that is that if we can smooth the claims experience, things become more predictable and the insurance company can operate more fluidly and with more predictability, which is obviously desirable. Now, it also helps to limit large losses because if an insurance company is covering a certain policyholder and there is an extremely large loss, this one individual loss might put them out of business. And that's a huge risk to take. So, insurers will also take insurance in case something like that does happen. Then the reinsurance company comes and saves the day and covers some of that claim or takes some of that claim, pays it. Now, there's also another key aspect to this which some people overlook is the access to reinsurers' capabilities and information. And when I say capabilities, what I'm meaning is their pricing, underwriting, and claims expertise. So it's obviously in the reinsurer's best interest to help the insurance company limit the amount of claims that they have or to manage their business as well as they can. And this is for obvious reason because if the insurance company has a large amount of claims or an excess amount of claims, then some of it might fall on the reinsurance company. And they obviously don't want to be having these excess claims either. So, in order to limit the amount of claims that they're going to have to pay, it's in their best interest to limit the amount of claims that the insurance company has to pay. So, their interests are aligned in that way. And the reinsurance company is oftentimes exposed to a larger degree of the market and it has greater exposure because it's dealing with lots of insurance companies and it has more data and information so it can aid the insurance company in its pricing, underwriting, and claim endeavors. Okay, now retrocession is sort of just another type of reinsurance. So retrocession is reinsurance for reinsurers, just as reinsurance was insurance for insurers. Now retrocession is just reinsurance for the insurers. So that's like what happens if this large loss that we were talking about for an insurance company was so exorbitant that it now has also affected the reinsurance company, and the insurance company and the reinsurance company together can't cover it. Or that year was a particularly bad year, then some of that can fall on the next reinsurance company. Now, I don't believe there are specific reinsurance companies that only do retrocession. What typically happens is they're amongst all the reinsurance companies, the big reinsurance companies, they will insure each other, and that is what's called retrocession. And so the reinsurer that is ceding the risk or transferring the risk to the other reinsurer is called a retrocedent, and the reinsurer that is providing the cover and will perhaps come to the rescue is called the retrocessionaire. Okay, so that's just a little bit of jargon. Now, with regards to the writing of reinsurance contracts, there's really two categories. There's treaty contracts and facultative contracts. Now, treaty contracts are in reference to a class of business. So this could be something like the motor insurance policies. And then what would happen here is that the reinsurance company would enter into an agreement with this insurance company whereby they have a certain contractual agreements with regards to the claims from the motor insurance business of that insurance company. And everything is kind of set up in advance. So the terms that they agree upon are set in advance and they're very complex, and it deals with the exact risks and exact claims, what things will be claimed for, what things aren't allowed to be claimed for, how much will each party be responsible for each claim, how much will they each have to pay, how much is the cover, how long will the cover last, the duration of the cover. And obviously what this gives rise to, this complex upfront terms, it takes into account so much that it makes the claims process simple. So what I mean by that is that it kind of outlines pre-specified solutions to every possible problem that might arise. And so the claims process is simple because there's nothing to think about or negotiate. Everything is already in the contract in this complex upfront terms that they've set up. Okay, now facultative reinsurance differs from treaty reinsurance is in that it's not really referring to a class of business. It's more so referring to specific risks. So some risks are so unique, or there's not enough demand for it to be a treaty contract where you group a whole lot of them, or maybe there's too few of those types of risks to warrant there being a treaty contract with complex upfront terms. So what will happen then is it'll be a facultative contract. Now, the reason why it wouldn't be treaty is because the whole thing about this treaty contract is we know exactly how certain things are going to behave, and we know there's going to be a lot of policies that are going to match that particular behavior of claims and of policy terms. And because we know a whole lot of them are going to match that, it's almost like an easing of the administrative burden with these complex upfront terms once off. We write them once off, and then we apply them to a whole class of business. Now, we can't do that for the facultative reinsurance because this refers to those specific unique claims or those unique risks that maybe we don't have a whole class of business for. And these unique risks might arise at specific times. And so we don't know exactly when that might happen, but we might know that right now, over the next 6 months, we're going to be exposed to this type of risk. And so we have to then go and look for a certain type of reinsurance to cover us as an insurance company over this time. And so we will enter into a contract with a reinsurance company with unique terms that we both negotiate. And we're looking for cover over this specific amount of time because this is when we're exposed to that unique specific risk. And obviously in this, where it's more specific to the scenario, it's not really a general application to all the policies in that class of business. It's that specific unique risk. So what comes with that is that since there aren't really set up terms in advance, we have to go negotiate everything. And then there's obviously a big administrative burden in the coming up of this policy. But then also, because there's not as much, we only have to come up with this policy once, the unique terms are maybe not as definitively set out. And also, we don't really know the nature of it as well because it's a unique risk. And so what happens then is that the claims process is more complex. So with facultative reinsurance, we set up our terms in a more simple way, but then when the claims come about, because we've set up the terms in a simple way, we can't really just always apply the terms without thought to that particular outcome. So we have to really give it a lot more thought depending on how our terms play out in reality and what things were covered for and weren't covered for. And so it becomes a lot more complex in the actual claims process. Now, there are a lot of pros and cons to each type of them, and I think I've mentioned some of them already. So I'm not going to go into too much detail with it, but I think it's more important that we just understand exactly what facultative and treaty reinsurance are, and then we can think of these pros and cons by ourselves. But maybe I'll just give you one or two. So a pro of the treaty reinsurance is that risks are reinsured automatically. So every risk in that class of business will be reinsured automatically, and we don't have to do it for each individual risk, which then obviously, as a pro for the treaty, it's a disadvantage or a con of the facultative reinsurance, whereby now we have to go and seek this cover for each individual risk, and there's no guarantee that we may find a reinsurance company who will be willing to give us the cover for that risk. Okay, and then another example maybe where a disadvantage of the treaty reinsurance is that there is little flexibility. So everything's set out in advance and nothing can really be changed. But with the facultative reinsurance, we're looking at these unique risks and we're negotiating terms in advance. So it's a lot more flexible to suit the need. Okay, so there's also a number of types of reinsurance. So typically there's proportional and non-proportional reinsurance. And proportional reinsurance is often referred to as original terms, and non-proportional reinsurance is referred to as excess of loss, or XL for short. Okay, now with proportional reinsurance, the cover that we are provided with as an insurance company from the reinsurance company is a percentage of each claim. So we know in advance how much percentage or what ratio of the claim I'll be paying and the reinsurance company will be paying. And with non-proportional, so it's not really now dealing with the ratio of the payment for a particular claim. We're dealing with beyond a particular claim value. The reinsurance company might deal with that, so it might pay it for us. So we'll pay everything under a certain value, and then if it exceeds that, the reinsurance company will take that risk. And then maybe we even specify an upper limit for the reinsurance company, and so beyond that, we then take on the risk again. Okay. Now, the purpose of proportional reinsurance is to try and limit the proportion of risk in each that each claim might give rise to. So we're looking at general proportions now, whereas for non-proportional, it's more about loss limitation. So obviously, when we are setting a limit, we don't want to pay anything beyond that, but below that, we'll pay. So this non-proportional is typically dealing with minimizing loss, and proportional is obviously also minimizing loss, but it's in a slightly different way. Okay. Now, proportional reinsurance is typically a type of treaty reinsurance. And what this means is that we apply this proportional model for reinsurance to all the policies that fit that class of business. So it's automatically administered. So the admin process happens automatically. We know every policy is going to take on, in that class of business, in that treaty, is going to take on the proportional type of reinsurance. And now non-proportional, it can either be treaty or facultative. And the reason why that may be is because we might be looking to limit loss across a whole range of policies. So, or in a specific group of policies. So for example, those motor insurance policies I spoke about earlier, that would be treaty, and maybe we are worried about those exceeding a certain value. So then we'd be looking at excess of loss reinsurance for a treaty. But we could also do that for facultative. So if we are particularly worried about one risk being exceptionally large for whatever circumstance, then we can apply this type of excess of loss reinsurance to that risk so that we can cover ourselves in case that massive claim does occur. Okay. Now, in proportional reinsurance, there's quota share and individual surplus. And what quota share is there's a constant ratio between what the reinsurance company and the insurance company pays for each claim. And individual surplus is where this ratio might vary. So I'll go into more detail with examples for those two, as well as for the types of non-proportional reinsurance. So for non-proportional reinsurance, there's risk XL, or risk excess of loss, and aggregate XL, or aggregate excess of loss. So risk XL deals with individual claims, specific claims, whereas aggregate XL will look at a group of claims. So then we look at how we aggregate these claims, which is why it can be further subdivided into the way that we aggregate those specific claims. Okay, so let's do this example on quota share, this proportional reinsurance. So in a 30% quota share agreement, how much does a reinsurer and insurer pay for a claim worth 10,000 Rand? Okay, so this 30%, if we have a 30% quota share agreement, the number that precedes the quota share agreement, that percentage, always looks at the percentage that the reinsurance company is going to take on, the percentage that the insurance company is ceding. Okay, so the reinsurance company will pay 30% of every claim, and the claim is worth 10,000 Rand. So then we say the reinsurer pays 30% of 10,000 Rand. I'll just say 10K is equal to 3,000 Rand. Okay, and if the reinsurer pays 3,000 Rand, obviously this whole claim must be paid for. So the insurer then by default pays 7,000 Rand. 10,000 Rand minus 3,000 Rand. Now you obviously also could have done 100% minus 30% is 70%, and then taken 70% of 10,000 Rand. That would also give you 7,000 Rand. Okay, now how much would they each pay if there was a quota share limit of 2,000 Rand? Now, once again, this number deals with the reinsurance company's limit. So this is kind of protecting the reinsurance company from taking on too much of this insurance company's risk. So that would then limit the amount that the reinsurer pays. So for this, the reinsurer would pay a maximum of 2,000 Rand, even though the quota share agreement is a 30% quota share agreement. They won't pay 30% because the limit was 2,000. So they'll pay 2,000 Rand. But now obviously don't go and say, for the insurer, don't go and say 100% minus 30%, 70%, and then say that the insurance company will pay 70% of 10,000, which would be 7,000, because that wouldn't make sense, because 7,000 Rand plus 2,000 Rand would only cover 9,000 Rand of the claim, but we still have to pay 10,000 Rand. So the insurer now would have to pay the rest, which is 10,000 minus 2,000, which is 8,000 Rand. Okay, so let's move on to the next example, an individual surplus example. Okay, so a car has an estimated maximum loss of 1 million Rand, and the retention limit is 600,000 Rand. What is the retention percentage and the ceded risk percentage? If there is a claim worth 500,000 Rand and 2 million Rand, how much does the reinsurer and insurer pay in each of these cases? Okay, so let's look at the first part of this question, finding the retention percentage and the ceded risk percentage. So the retention percentage is always just going to be equal to the retention limit. Now I'm going to use abbreviations here. So RL for retention limit and EML for estimated maximum loss. So the retention percentage deals with the percentage of each claim that the insurance company is going to keep. Okay, so that'll be 600,000 Rand over 1 million, which is equal to 60%. Okay, now one thing to note is when we're looking at the estimated maximum loss, it literally is just that. We're estimating what is this maximum loss that we might pay for a particular claim. And then we also look at, as an insurance company, what is the maximum that we'd be prepared to pay, or that we'd be willing to pay for each claim. Now, these two maximum numbers, the retention limit, the amount we're willing to pay, and the amount that we may potentially have to pay, will define the amount that the percentage of the claim that we actually do pay. So even if the claim is worth more than this estimated maximum loss, and we end up having to pay more than what we are prepared to pay, that's just how it is. That's so be it. This estimated maximum loss and retention limit is all to find the retention percentage, and this retention percentage will define how much we pay. So even though we were only willing to pay this retention limit, we might end up having to pay more because our estimated maximum loss is lower than the actual claim that does occur. So the ceded risk percentage is the amount of risk that we pass on. So that is just 1 minus this retention percentage. So I'll say the ceded risk percentage is equal to 40%. Okay, and this 40% you can just obviously get by 100% minus 60%, or you could also go the estimated maximum loss minus the retention limit over the estimated maximum loss, and then express that as a percentage. That's fine as well. Okay, so let's deal with the second part of this question. If there is a claim worth 500,000, and then also we're going to do one for 2 million Rand, how much does the insurer and reinsurer pay? Okay, so the insurer pays the retention percentage, and the reinsurer pays the ceded risk percentage. Okay, so the insurer then is going to pay 60% of 500,000. So we'll say 60%, or rather, let me do it like this. Let me say this 500,000, it's going to have to be paid for. So I'm going to split it into the 60% and then the 40%. Now the 60% is going to be 60% of 500,000. That should give you, well, 60% of 1 million would be 600,000, and 500,000 is half of a million. So that would be 300,000 Rand for the insurer. That's the retention that the insurer retains, okay? And then 40% is just whatever's left over, so that'll be 200,000 Rand for the reinsurer. So that's the ceded risk. Okay, now, if we had this 2 million Rand, this is an example where the actual claim exceeds the estimated maximum loss. So this 2 million Rand would be split into, once again, the 60% and the 40%. And this 40% would then be 800,000 Rand for the reinsurer. And then the 60% would be 1.2 million Rand for the insurer. And you'll notice here that the insurer is paying 1.2 million Rand, but they were only prepared to pay 600,000 rand. So they're paying double that, and that can happen. So this retention limit is not actually the maximum that they'll pay. It just helps us define the percentage that they'll pay of each claim if we also guess the maximum of each claim. Okay, so let's move on to this next example. The estimated maximum loss for a motorbike was 300,000 rand. The retention limit remained at 600,000 rand, and there was a claim worth 200,000 rand. And then we'll also do it for 700,000 rand. And we want to know what is the retention percentage and how much does the reinsurer and the insurer pay in each case. Okay, so retention limit 600,000 and estimated maximum loss 300,000. We know this retention percentage is going to be equal to the retention limit over the estimated maximum loss. But in this case, the retention limit exceeds the estimated maximum loss. So we can't go and say 600,000 over 300,000 and then say that they retain 200%. That doesn't make sense. Only 100% of the claim will be paid for. So in this instance where the retention percentage exceeds 100%, we will just say that it is 100%. So the insurance company will retain 100% of the risk. Okay, and then obviously the ceded percentage will be 0. Okay, so in this case, how much does the insurer and reinsurer pay for each of these cases where a claim is worth 200,000 rand and 700,000 rand? So for this 200,000 rand claim, they've retained 100% of the risk. So they're going to pay 100% of the claim. So the insurer pays 200,000 rand in the 200,000 rand case, and then they'll also pay the full amount in the 700,000 rand case, even though that exceeded the retention limit, the maximum that they were prepared to pay. Okay, and then the reinsurer in both cases, the 200,000 and the 700,000, will pay nothing. Okay, so let's move on to a risk excess of loss example. So if the excess point is 1,000 rand, there is a claim worth 5,000 rand, and the reinsurer pays 3,500 rand. What is the upper limit of this contract, and how much does the insurer pay? Okay, so let's draw a diagram to try and understand what's going on here. Okay, so this whole block will represent the total claim value. Now, that we can think of this lower line as 0 rand, and this upper line as whatever the claim is worth. So this claim was worth 5,000 rand. Okay, now on this, we need to specify a excess point and an upper limit. So the excess point we know is 1,000 rand. And then there's going to be an upper limit somewhere. Now maybe the upper limit is above this 5,000 rand. Maybe it's below this 5,000 rand. All we know is that it's going to be above that excess point, but we have to try and find it. Okay. Now we know that the reinsurer paid 3,500 rand. The reinsurer pays between the excess point. So this here is the excess point, and they'll pay between the excess point and the upper limit. And the reinsurer paid 3,500 rand. So that takes the total then from 1,000 rand to 4,500 rand. We can see 1,000 rand plus 4,500 rand is equal to 3,500 rand. So this is the reinsurer's portion. And obviously below the excess point, the insurer will pay everything. So this is the insurer's portion. And then above the upper limit, the insurer will pay everything again. So this is the insurer's portion again. Okay. Now, we know that the upper limit is going to be 4,500 rand, just because the reinsurer pays between the excess point and the upper limit. So in order to get to the upper limit, we have to add the amount that the reinsurer pays to the excess point. Now, that may have meant that if the reinsurer paid, let's say, 4,000 rand instead of 3,500 rand, then that would have taken this upper limit all the way up to the top of this claim, and then we wouldn't have known what the upper limit was, because how would we have then been able to differentiate between the upper limit being there and the upper limit being maybe somewhere way higher than that? And the thing I'm trying to get at here is that If the claim was only worth 5,000 Rand and the reinsurer paid 4,000 Rand in this hypothetical example that I've made up, then we don't know whether they reached the upper limit or not because they paid everything above the excess point. So then we wouldn't be able to specify whether they reached the excess point or not. But because, the upper limit point or not. But because the excess point, in this case, plus the reinsurer's portion equals a number that is lower than the total claim value, we can actually specify this upper limit with certainty. Okay, so we know the upper limit then is 4,500 Rand, but there's another part to this question. We want to know how much does the insurer pay? Now, you can look at the diagram and work that out, or you can simply work it out from the information given. Now, we know the claim is worth 5,000 Rand, and the reinsurer paid 3,500 Rand. But the entire claim must be paid. So we pay everything that the reinsurance company doesn't pay. So the insurer will pay 5,000 Rand minus 3,500 Rand, which is 1,500 Rand. And you can also get that by adding those two insurance portions, 500 Rand plus 1,000 Rand, once again equals 1,500 Rand. Okay, so let's move on to this next topic of aggregate Excel. Now, I mentioned earlier that there are a number of different ways to aggregate your claims. Now, there's typically three ways that we'll deal with. So the first way is by an event. So this is all claims that arise from a specific event that occurred. So this might be flooding, for example. So there's a massive flood in a city, and this leads to a large number of claims. And all the claims that arise from that particular flood will be from that event, and we'll call that catastrophe XL. So catastrophe excess of loss. That's how we'll classify it. Now, there's also the aggregation of claims due to a peril. A peril is really just anything that exposes someone to risk or potentially means that they'll be affected by something. So, for example, a peril would be a fire. Now, a fire can cause damage. So there's a potential risk associated with a fire. So a fire would then be a peril. And then a hazard would be something that worsens the risk associated with that peril. So this could be a drought could exacerbate the effects of a fire because the fire spreads more easily, or there's poor electrical and plumbing maintenance, and that could cause a fire. So that would also be a hazard. So the hazards are things that exacerbate your perils. Okay, so we could aggregate by peril. So this could be all claims that arise due to fires. Now, note the difference between event and peril. Event is one particular peril that happened. So one flood that damaged the city, whereas a peril could refer to claims arising from all types of floods. So from all the floods that occurred. Okay, so the event then is that one particular flood, and then we aggregate according to all the claims that occurred due to the damage from that one flood. But then all floods that are occurring in the year that give rise to claims, or all fires that gave rise to claims, we'd call those perils and would aggregate by those perils. Okay, now there's another one, which is another way to aggregate, which is class of business. So this is really just you could go by your motor insurance policies, and then what you'd refer to this as is a stop loss. So you'd essentially, by taking out reinsurance as an insurance company, taking out reinsurance with a reinsurer for a particular class of business, for your motor insurance policies, you'd be stopping your loss on those policies if the loss were to exceed, or the claims were to exceed a certain amount. So we call it stop loss. Okay, so let's do an example for our aggregate Excel. So we're asked to illustrate the concept of a stop loss payment between an insurer and a reinsurer. Okay, so once again, we'll revert to this diagram. And since the question doesn't really give us exactly what we must include, we should include as many specifications as we could, and to try and encapsulate what could happen with a complex stop loss payment. Okay, so once again, this entire block will represent our total claim, and then we'll have an excess point. And then we'll also have an upper limit. Now, for this particular claim, we are assuming that it exceeds the upper limit, but it might be the case where the claim only went up to there, for example, and then it's below the upper limit. Okay, but for illustrative purposes for this diagram, we're going to say that the upper limit is below this total claim value. Okay, and now let's also incorporate another factor into here where we say that the insurance company will compensate the reinsurance company for 30% of the risks that they cover. So now instead of the reinsurance company taking on that entire amount, the difference between the upper limit and the excess point, they'll take on a certain percentage of that amount. So if we said then that the insurance company will retain 30% of the amount between the excess point and the upper limit, then we'd say this, let's say, is 30%, or let's rather call it generally X%, then this would be 1 minus X%, and this would be the insurer, so insurer's portion. So I'm just going to write I for the insurer and R for the reinsurer's portion. Okay, now let's try and understand what's really the benefits of having something that looks like this. So obviously we understand that having an excess point is beneficial, and having an upper limit might be beneficial for the reinsurer. So we know as an insurance company that below a certain amount, we'll pay for those. We'll pay for those claims, and we'll only bring in the insurance company when it exceeds this excess point, a claim. And then the insurance company says, you know what, up to a certain point, I'm happy to provide cover for you in exchange for a premium, but there's a certain cap that the reinsurance company wants to put in place. They don't want to pay beyond a certain amount, so they specify an upper limit. So they'll pay everything up to that upper limit that exceeds that excess point. But now what might happen is that the insurance company will pay here, and it'll pay nothing in this period, but then it'll end up paying a massive amount later on. So it might be then more convenient to specify something where the insurance company will pay for part of this in between portion. So it's more so just another specificity that we are bringing into our stop loss payment, and it can help us in that we're not just paying below a certain point and above a certain point. We're also actually involved in paying some of the claims beyond in between these two values, because the reinsurance company may not want to every time take on all of that. And if this upper limit is, let's say, particularly high, then the reinsurance company might end up taking everything, or a large number of these total claims every single time. So they'll say, you know what, we have this upper limit, it's very high, and because this upper limit is very high, I'm going to ask this insurance company if they can also take a percentage of these claims that fall between the excess point and the upper limit. So that's just another feature of this stop loss payment. So I hope you enjoyed this video and you found it interesting and useful. And if you did, please don't forget to give it a like and subscribe. Thank you for watching.